Welcome to your daily dose of clear, confident English where we learn, practice, and grow together. 1. Origins, where it all began. The concept of a stock market didn't appear overnight. It evolved from simple trade and lending systems. 1100s. Merchant lending in Europe. In Venice, merchants would trade government debt, which laid the groundwork for organized financial markets. 1602. First official stock exchange. The Dutch East India Company issued the first publicly traded shares in Amsterdam. This gave birth to the Amsterdam Stock Exchange, widely considered the world's first official stock market. This was revolutionary. Instead of one person funding a whole risky expedition, many investors could each buy a share and spread the risk and the rewards. 2. Growth of global exchanges. Once the Dutch showed it worked, other nations followed. London Stock Exchange, LSE, began informally in coffeehouses during the 1600s and became official in 1801. New York Stock Exchange, NYSE, founded in 1792 under the Buttonwood Agreement, named because it was signed under a buttonwood tree. The NYSE eventually became the largest stock exchange in the world. Other markets. By the 19th century, exchanges were popping up in Paris, Frankfurt, Tokyo, and Bombay, now Mumbai. 3. The mechanics. How the stock market works. A stock market is essentially a meeting place, physical or digital, where buyers and sellers trade shares of companies. Stocks represent ownership in a company. Brokers, middlemen who execute trades for investors. Indices, tools like the Dow Jones Industrial Average or S&P 500 that track overall market performance. Bear markets. Bull markets signal rising confidence in prices. Bear markets mean falling prices and pessimism. Today, most trading happens electronically in milliseconds through computer algorithms. 4. The great crashes and booms. The market has seen its share of euphoric highs and devastating collapses. 1929, the Great Depression. Over-speculation led to a massive crash, wiping out fortunes and sparking a global economic crisis. 1987, Black Monday. The Dow Jones fell over 22% in a single day. 2000, dot-com bubble. Internet company stocks soared unrealistically before collapsing. 2008, financial crisis. Triggered by the U.S. housing market collapse and risky banking practices. 2020, pandemic shock. COVID-19 caused a sharp drop, followed by one of the fastest recoveries in history. 5. The modern market. Today's stock market is global, fast, and heavily influenced by technology. Electronic trading. Almost all trades are now handled online. High-frequency trading uses algorithms to buy and sell in microseconds. Retail investors. Platforms like Robinhood have brought millions of everyday people into the market. Globalization. Events anywhere from oil prices to political tensions can ripple through all markets instantly. 6. Why it matters. The stock market isn't just for wealthy investors, it affects everyone. Companies raise money to expand and innovate. Retirement funds and pensions often rely on market investments. Economic health indicators like GDP growth often move in sync with market performance. 7. Key lessons from history. Diversification is survival. Spreading investments across sectors reduces risk. Speculation can be dangerous. Overconfidence often leads to bubbles. Markets recover, but timing is impossible to perfect. Long-term investing has historically beaten short-term gambling. Final thoughts. The stock market started as merchants swapping risk on ocean voyages and evolved into a trillion-dollar digital network. It's been shaped by greed, fear, innovation, and human behavior. Understanding its history helps investors navigate it with more caution and more confidence.